Are we witnessing the death of paper money? So there's a lot of big changes in the global macroeconomic landscape that happened last week. And before we talk about Fitch's downgrade of the US, I want to talk about Japan, and in particular the yield curve control change that the Bank of Japan announced at their policy meeting. Now, this is going to have big implications for foreign investors. So if you're an investor in the US and in Europe, and in particular Australia, because I'm going to focus in this video a little bit for Australian investors, because most Australian investors are oblivious to what this potentially might mean for them. Even if you're not an investor, this is still going to have big implications for people all around the world. So, but before we get into that, what I want to do is just cut to a little clip from Weston's video last week. Now, I'll put a link in the description below. Highly recommend you watch it. It's a long video, but very well done.
So today, we're going to discuss the Bank of Japan's policy shift itself. Whether or not this is the start of a policy tightening cycle for Japan, what's been happening in markets, as well as broader global market implications. You know, what are the other potential policy implications for other central banks, such as that of the ECB, the Fed, whatever. And then just generally, what the hell happened today? What was that all about? What does this fundamentally mean for us market participants? Why should we care? Okay. And by we, I mean all of us. Okay. Not just myself in Japan. I mean all of us global market participants and observers of markets everywhere, especially in developed market economies like the US and Europe. And if you're in one of those regions, and even if you're not, right? But if you are and you're thinking to yourself, why should I care? I have no direct portfolio exposure to Japan. Yeah, well, you know what? It's not only about who or what you have direct or even indirect exposure to, it's also about who or what has direct exposure to you. Japan investors are the world's largest foreign fixed income investors. Trillions deployed overseas, probably into your sovereign bond market, your government bond market itself. Okay? European sovereign bond markets and the United States Treasury market, the largest foreign holder of US debt. So, when there's a major change in the largest creditor to the world's risk-free rate, then yeah, you have portfolio exposure, if not implications, and so therefore you need to sit up and pay attention. All right, but before I go any further, I'm going to lay out what, as I see it, the big picture story that's taking place is. Okay, and so here's what I need all of you to really just grasp at the fundamental base level, over and above anything else today. It's something that's being completely overlooked, or rather just completely underappreciated, both outside of Japan and inside of Japan. Okay, big picture is as follows. Today's policy measures and policy statements are ultimately not about the yield curve control levels and where JGB yields are, nor is it about Japan's CPI and the Bank of Japan's own CPI revisions that were made higher today. Nor is it about dollar yen with a 130 or 140 or 150 handle. Okay? What the Bank of Japan's policy release did that fundamentally changed the game, and instantly so, right, at least for the foreseeable time being, is that the Bank of Japan is attempting to reclaim its control over the path of how it executes monetary policy by yanking yield curve control out of the hands of the markets and back into the hands of the Bank of Japan, or as I call it, YCCC, yield curve control.
So former central banker Kathleen Tyson shared this chart showing the state of the world's debt, government debt by country measured by debt to GDP, and you can see Japan is the most indebted country in the world. But she says repatriation flows could be a significant source of destabilization if JGB rates continue to rise. 0.6% this morning is a 15-year high. Well, it's gone even higher than that now. Now, for Australian investors or Australians in general, why is this even of any significant importance? Well, Japan is the single largest investor in Australian fixed income. Okay, so Japan, as you know, have huge savings. They have a positive net international investment position. They've got massive savings that because of low Japanese yields, Japanese investors have sent that savings internationally to seek higher returns, and that includes Australia. So Japan are the largest investor in Australian government bonds, and you can see from this chart. And so this data here is from December 2018, which shows that Japan owns about 250 billion in Australian government bonds, approximately 7% of the overall of their overall fixed income allocation. However, latest data, and I'll show you a chart shortly, says that Japanese investors could own up to 15% of all Australian government debt. So you can see this chart here, and this is from the Australian Office of Financial Management. So the Australian government, you can see the massive increase in Japanese investors buying Australian government bonds throughout 2020. You can see it goes almost vertical. Now, it has come off a little bit. Japanese investors have sold down a little bit, and a lot of that has come due to hedging costs. So currency hedging costs for Japanese investors in Australian dollar positions has increased, which has caused many investors to engage in more spreads and take duration risk and even remain unhedged altogether. So, and as well, just getting out of Australian dollar assets, government bonds in particular. However, it still remains elevated, very, very high. So from here, you can see Australian government bonds have been purchased a lot by Japanese investors. So if a repatriation begins and there's a big sell-off on Australian government bonds, that's going to push yields higher. That's going to change banks' funding costs as well. So that's going to rise, which means mortgage rates are going to rise. Doesn't matter what the RBA does, the Reserve Bank of Australia, doesn't matter what they do. Yields are going to rise on government bonds. Yields are going to rise on other fixed income or bond securities like corporate bonds and mortgage-backed securities, which means mortgage rates are going to rise. And what's that going to do to our housing debt bubble, which I'll come to in the next video. And this chart is Japanese investor foreign asset holdings by currency. And of course, the US dollar being the global reserve currency, they'd hold a lot of that. Euro being a big currency, they'd own a lot of that and their own currency as well. But outside of that, Australia's the next biggest. For a little country like Australia, they own a lot of our currency. So once again, if they start selling and repatriating, that is a lot of demand for our currency being thrown back out there. Our dollar goes down, input prices rise, CPI rises, kind of forces the RBA to rise anyway, doesn't it? So for Australians, we've got a big problem here. And I've got some more to share with you guys on this whole issue, and in particular for Australian investors. But what I might do now is for our US investors is cut to a clip from Peter St. Onge, who is an Austrian economist, and I'll put a link below to his Twitter handle. I absolutely recommend everyone follow him on Twitter. He does these great little podcasts, great little clips, little 3-4 minute clips where he just gives you some real, if you like bite-sized snippets of valuable information, he's the man to follow.
Last week, the Bank of Japan shocked markets by announcing big changes to its decade-long flood of cheap money. Will Japan now join China in pulling trillions out of the U.S., taking out the cheap money propping up our ruling clowns? So what happened? The Bank of Japan announced they're winding down their decade-long yield curve control, a system of manipulating interest rates so money is cheap to borrow without hurting pensions and banks. That policy has already driven trillions offshore seeking higher returns, especially to U.S. and European stock markets and bond markets, but above all to U.S. treasuries. And now those trillions could be going back to Japan. So what is yield curve control? Bond yields are the interest rate you get for holding a bond. A 2% rate means you get $2 per year on a $100 bond. I mentioned the yield curve in a recent video, but it measures the interest rates for different lengths, so 1 year, 5 year, 10 year. What Japan wanted was essentially zero rates on the 1 years and 5 years to artificially stimulate its economy, with only slightly higher rates on the 10 years, since Japanese pensions would go bankrupt if their long bonds were earning negative rates. To keep rates low, the Bank of Japan promised to buy as many 10 years as it takes. Remember, by buying bonds, it raises the price, which means a lower rate of return. To illustrate, if a $100 bond is paying 2%, so $2 in interest, and the price goes to $200, now that is a 1% bond. Fantastic, of course, if you're a banker who owned the original $100 bonds, which are now worth $200. The problem is this meant massive injections of fresh money into the economy, to the point the Bank of Japan now owns a majority of Japanese government debt, over $4 trillion. In fact, the Bank of Japan is now the largest owner of stocks in Japan, owning 80% of new exchange-traded funds, ETFs, and owning over 7% of all the publicly held corporations on the Tokyo Stock Exchange. This is not sustainable. At some point, the Bank of Japan owns everything in Japan. Even the Soviet Union did not own literally everything. So the bank knew it could not go on forever. In fact, they had already pulled back a couple times, bumping the 10-year ceiling in 2018 and then 2021. But now they ripped off the Band-Aid, saying they'll abandon targets altogether. They did promise flexibility to try and calm markets, but the move still sent Japanese stocks and the yen in gyrations. For Americans, the main impact is that Japan's low rates have so far sent about $3 trillion offshore, overwhelmingly to the US and Europe, chasing higher returns. If zero policy is now history, that money will start to go home, meaning they will sell U.S. treasuries, U.S. stocks, European bonds and equities, everything from Brazilian sovereign debt to European power stations to high-risk loans. This could further drive down, especially the U.S. dollar, which has already fallen almost 15% since September. Now that Chinese are pulling money home to shore up their slowing economy, if Japanese money too is going home, that takes out $2 trillion stacks that have been floating the US and European economies and the currencies. The free pass may be coming to an end. Okay, we'll be watching. See you next time.
And this from Warren Hogan, an Australian economist. I have had to reread the RBA statement from today. They've just pushed out the return of inflation to target by 6 months without any explanation. This represents a break with past practice and stands in stark contrast to what other central banks are doing. It's a profound change in Australia's economic strategy. So this is with the RBA's decision last week to remain on hold at 4.1%. He also says the governor's statement today should have started with, we've decided to push out the return of inflation to target by 6 months. This is because, whatever, a profound change in monetary policy strategy that is completely at odds with what is happening in other countries. Massive call, possibly influenced by new board members, leaves us hugely exposed to inflation risks and hurts the most vulnerable in our community. And why? Our labour market is white hot. They have ample downside protection from the effects of higher rates on employment. And then John Keough, who's an economic finance journalist in Australia, said, I suspect RBA not done increasing rates, even if it hopes so. Late 2025 return to top of inflation target, that's 3%, may stretch central bank credibility. It's not costless to again delay return to 2 to 3%. It reduces the Aussie dollar, increasing imported inflation and potentially higher inflation expectations, something I've been talking about for quite a long time. But then Warren retweets that and says, agreed, the RBA has completely given up on being preemptive, preferring to focus on their core scenario, the narrow path, and will only respond to risks as they become a clear and present danger, reminiscent of the no hikes until 2024 debacle. Central bankers aren't there to simply adjust interest rates as the data changes. Their job is to assess the range of possible future outcomes for unemployment and inflation and to adjust rates to reflect the distribution of risks. That is something they have struggled with for a number of years now. We are going down a very different path to other countries around the world with our apparent willingness to tolerate inflation risks. Or as the RBA decided that we're going to not try and pop the housing bubble, the debt bubble, which I'll do in the next video, and therefore risk the currency. So David Taylor, another Australian economic and finance journalist, says Australian dollar down over 1% against the greenback. Large move for a currency, always going to happen with an on-hold RBA decision. Big gap now between US rates and Aussie rates. International money follows the higher rates for yield return. Pretty basic economic stuff, right? And something I've been arguing for a long, long time, that the RBA really ultimately is not in control. But the good thing is, even though I've been talking about Aussie interest rates, and we sent a letter out to clients in November of 2021 saying that interest rates were going to rise substantially, and we shared evidence as to why we said that, and we've got all of our RBA rate rises correct, except for the last two on the pause. And we've been talking about all the dollar flows and how really ultimately the RBA are not in control. And it's good to finally see some economic and finance journalists starting to talk about it. So these articles that I've just shared and these tweets have only been in the last week, the last few days. And this article from Robert, dollars dip raises alarm. Further falls could boost inflation and interest rates. This is what we've been arguing for such a long time now. And a lot of Aussie investors and a lot of Aussie homeowners with mortgages have no idea what I'm talking about. But back in April, I think the 13th of April, Michael Every has just said the RBA was once a credible central bank, but now is a global laughingstock and believes a crash in the Aussie dollar is coming. So that was back in April, before the RBA have now given up on the inflation fight, and is happy for other central banks like the Bank of Canada, like the Fed, the RBNZ, Bank of England, etc., and now Bank of Japan to raise rates, and allow that differential to happen. Why? To protect the debt bubble that we have, the housing debt bubble. Which once again, I'll come to the next video. I want to tell you right now what our debt bubble is like compared to other countries, but I'll save that for the next video. And this article from NASDAQ. Reuters, Australian bonds face squeeze as Japan's cash returns home. And no, that was not written in the last week. Have a look at the date. February 5, 2023. So Japanese investors are extending their march out of Australia's $600 billion bond market, it's even bigger now, amid risks that it becomes a rush later this year at any further hint of a policy tweak from the Bank of Japan. Well, remember, this is back in February this year. Bank of Japan have now made that tweak. Estimates vary, but analysts believe Japanese investors own between 7 to 15% of Australia's sovereign and semi-sovereign bonds. By the way, semi-sovereign bonds is state government bonds and whatnot. A higher proportion than their roughly 4.7% ownership of the US Treasury market, leaving Australia uniquely exposed. I bet you nobody knew that. Bond dealers say the situation has attracted short sellers as speculation swirls that Japan will ultimately start to exit ultra-easy monetary policy, let the market set bond yields, accelerating the repatriation of Japanese money. The positioning also leaves other investors and the price of borrowing for Australia's government vulnerable, as at least 15 years of reliable Japanese inflows could reverse as yields in Japan start to become more attractive. Japanese investors that have looked at higher-yielding markets like Australia will have an alternative if that happens, said Andrew Lilly, Chief Interest Rate Strategist at investment bank Barrenjoey in Sydney. People have concluded Australian government bonds will underperform because Japan is seen as more of an outsized buyer of Australian bonds than they are of Euro area or US or UK bonds, he said. In fact, many people have short Aussie bond positions. A swinging yen and the increasing cost of currency hedging for investments abroad have contributed to Japanese selling so far by eroding the yield benefit of international holdings. Bank of Japan data showed net Japanese selling of Australian debt 240 billion yen or 1.7 billion Australian from January to November last year, the most recent figure available on top of 1.5 trillion yen of net selling in 2021. December and January data is not yet available, but there are signs demand for Australian bonds is ebbing. Japanese investors took just 2.3% of the last syndicated bond sale of $14 billion Australian of 2034 paper, compared to 32% for the rest of Asia, data from the Australian Office of Financial Management showed. The risk from here is that limited Japan selling in 2022 of Australian fixed income could pave the way for a more aggressive sell down in 2023 should the Bank of Japan policy shift more hawkish. Well, that's exactly what we've seen. All right, so let's quickly touch on the downgrade last week from Fitch of the US. And US Treasury is looking at issuing $1.85 trillion in new debt in the second half of this year. And this was shared by Joseph Wang, the Fed guy. And if you have a look at this, compared to the same quarter last year, tax revenues declined 11%, while expenditures increased 10%. So this current administration are really, well, like drunken sailors. You know the saying. In fact, speaking of that, what we'll do now is we'll just cut to another clip from Peter St. Onge on this very topic.
Credit rating agency Fitch downgraded the federal debt. Are we moving from the gradually stage to the suddenly stage? Fitch is one of the big three credit rating outfits together with Moody's and S&P, and they dropped the federal government from their highest rating, AAA, to their second highest, AA+, adding they see a, quote, steady deterioration that could suggest more cuts to come if nothing improves. Now, given the federal deficit is up 170% on last year alone, in all likelihood, nothing will improve. The proximate cause of the downgrade, of course, was rising federal debt. Fitch estimates it will hit 118% of GDP by 2025, which is more than 2.5 times the AAA country median of 39%. So it was already a friend rating. Fitch cited the repeated last-minute debt ceiling standoffs amid 20 years of deterioration in, quote, fiscal and debt matters. Biden's staff added that January 6th was a factor, which Fitch didn't mention in their report, but extra points for creativity. Note, this kind of downgrade did happen once before, in the 2011 debt ceiling clash, that time by S&P. Because our nation is governed by laws, 2 weeks later, the federal government opened an investigation whether S&P caused the 2008 mortgage crisis, at which point S&P fired its CEO, so that was just 18 days from downgrade to unemployment. Even NBC, which wasn't quite as bootlicky back then, connected the dots and questioned the timing. So we will see if any Fitch executives get that pink slip, but so far the administration has, of course, strongly disagreed with the downgrade, with Janet Yellen saying Fitch used, quote, outdated numbers, to which Zero Hedge responded, yes, they are outdated. Debt payments have actually doubled to roughly $1 trillion. And the CBO, Congressional Budget Office, is now projecting a $50 trillion national debt. So what is the impact of the downgrade? In theory, higher interest rates on government debt, meaning a rise in that $1 trillion we already spend on debt service, itself on track to $1.6 trillion this year. If federal debt is now risky, that makes investors nervous, so they require higher rates, which could push us towards $2 trillion in debt service. By the way, the entire federal government only collects about twice that, $4.8 trillion, meaning almost half of every tax dollar could soon go to servicing, not paying off mine, just servicing old debt. Still, it is worth noting that last time in 2011, the opposite happened. Stocks fell, but treasuries and the dollar actually rose in a flight to safety typical of any crisis. So near term, that could happen again, even if longer term is a weaker dollar and higher debt interest. The fundamental issue here is that the U.S. government is spending like a drunk sailor with a stolen credit card. They're also drinking like drunk sailors. And even intimidation of credit rating agencies is not hiding the fact. I would not hold my breath for anything to change. The feds will just pay any higher interest with yet more debt. As always, accelerating the crash instead of fixing it, kicking that can over and over until you kick it and it doesn't budge. Okay, we'll be watching. See you next time.
So what do I see playing out from here, both in regards to the Bank of Japan decision and also Fitch's decision? Well, we're already seeing it. Higher yields, government bonds, it's pretty clear. And whether it's 10-year, 30-year, I mean, I noticed some comments from Peter Schiff the other day saying that he expects yields on the 10-year to be over, 5%, which probably isn't too far away, and later this decade, double digits, and interest rates to be double digits, inflation to be double digits, etc. So, look, I think we're in, and I've said this multiple times, I think we're in for an inflationary decade ahead. A lot of pain, and a lot of it due to the fiat monetary system really coming to an end, isn't it? And that's why I think risk on assets isn't appropriate for myself at the moment, or at least having a small percentage of my portfolio in that. I want to be in risk off assets, and I want to be in assets that are going to benefit over the decade ahead with inflation and much higher CPI. I see more problems, and we're going to have disinflation and inflation, etc., etc. But it's not going to be a fun time. And debt, well, people say you want to have debt during inflationary periods. This decade, yeah, I wouldn't want to be loaded up in debt. I'd want to be trimming debt. Personally, I have zero debt, and I'm very comfortable with that. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.